Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance, and on this episode, we're going to discuss updated job market data, 2026 IRS Standard Deduction, 2026 retirement plan contribution limits, and a look at the Plan Solutions Incorporated Office Bulletin Board. Mr. Armour, how are we, good sir?
Well, we always record this ahead of time, so I'm looking forward to my favorite holiday, which is Thanksgiving. Right, food and football, and I've been fighting the good fight of not letting any Christmas stuff get put up or anything until Friday. It's not been easy. It's not been easy.
Well, yeah, I mean, knowing the missus, she's definitely festive and likes to make the house fun for every holiday season. But yeah, I'm glad you held your ground on it there.
So far, we'll see how it goes.
Yeah. After that, I mean, are you going to Clark Griswold it, get out, put up some lights, or just letting it all be inside?
Yeah, no, we'll probably be doing that. Although I've been threatening my daughter that we won't know until the Nebraska-Iowa game on Friday whether Christmas is canceled or not. So, but hopefully, yeah, wake up Friday, watch Nebraska beat Iowa, put up Christmas decorations. Right? Hopefully, that's the order of operation.
All right, sounds good. I had somebody ask me, why do you cheer on a college football team that you didn't go to? And I said, my college didn't have a football team, so I can pick whoever I want.
Yeah. My college had a team. They've gotten better, but it's just when you start out a Nebraska fan as a kid, it's I guess I'm just loyal, right? I'm just loyal like that. I have a hard time changing.
Yes, sir. Yes, sir. All right. Well, let's jump into our first topic, updated job market data. During the federal government shutdown, many sources of important economic data were suspended. We've already talked about this, where it's, left economists to speculate. But what are we seeing now that, the government shutdown has ended? Are we seeing anything and data around, layoffs, slowing hiring, or is that accelerating? Where are we at?
Yeah, I think this is a good opportunity to level set because we really got not just one jobs report, but three pieces of job data that we were not getting during the government shutdown, and each of them is kind of important in its own way. And I think this gives us a good opportunity, like I said, to level set because with there was just a lot of anecdotal data and a lot of it was coming in negative, saying, oh, we're seeing layoffs, we're seeing this, the job market must be deteriorating. But we really didn't have a lot of information. We didn't know what was going on. So yeah, kind of things back to normal to some degree. I mean, this is the report that was delayed. So it's going back to September, but basically what the Bureau of Labor Statistics is saying is that during September, the U.S. economy added 119,000 jobs. So that, well exceeded the 50,000 that was expected and actually represents an acceleration. They revised the August report down to a loss of 4,000 jobs. So obviously that was not good. And revised down July to a loss or a gain of 72,000. So, because the jobs report can be volatile, often will, take 3 months or 6 months and get that average. And so with this strong number in September, that's a 3 month average of 62,000 jobs, which, is a mild growth rate. It's basically saying the labor market's not running too hot, but it's definitely not running too cold.
Yeah, a good positive sign. I mean, we never hit a perfect equilibrium, but what does that mean as far as then with unemployment's rate? The unemployment rate, we've talked around it and monitored it closely and what it signifies.
Yeah, so the unemployment rate comes from a different survey, right? So this is, this actually is entirely different information. And the unemployment rate ticked up slightly to 4.4%. So this is the highest level we've seen since 2021. But typically, any rate below 5% is considered to be a sign of a strong job market, right? It's always been kind of 5% or lower is considered to be full employment. And then the other thing to remember is we've talked about in the past is the unemployment rate is typically considered to be the backward looking indicator. It's more driven by the number of people that lost their jobs and then stay on unemployment, right? That
Right,
so
right.
that number grows, as opposed to what's happening right now, which is more the jobs report that we just talked about that showed a pretty strong month of September. So it's kind of the unemployment rate is saying, okay, well, it ticked up a little bit. Things not, maybe not quite going in the right direction, but that's where we've been.
Hmm.
Then you have 119,000 jobs in the most recent month, so that's where we are, right? So it's showing some trends of improvement. And then the forward-looking indicator, basically what gives you a better indication of where we're going is the initial claims for unemployment benefits.
Okay. And what are we seeing as far as the initial claims for unemployment benefits and it being a forward-looking indicator?
Yeah, and we also, just with the way they do the data, it's a little different. So, like I said, the jobs report, the unemployment rate, those were all for September, right? So they went back and kind of tried to, do the best they could to create that. With the initial jobless claims or initial claims for unemployment, that's a weekly indicator. And so it looks like rather than going back and trying to fill the gap, they just started from November 1st and moving forward, or at least in terms of what they've published. So we may end up with, roughly a 1 month gap in the data, which happens occasionally. But basically, starting with November 1st, we've had 3 months of data now. We just kind of put out there in a data dump. It shows 229,000 claims for unemployment in the first week, 228,000 in the second week of November, and just 220,000 for the third week. So, that's basically in line with the levels that we were seeing at the end of September before the gap in the data. And typically, any number below 250,000 is considered to be a sign of a strong labor market. So, we're seeing what would be considered a pretty low number of new claims for unemployment benefits, which again, because that's the forward-looking indicator, is really saying that it appears that things are improving.
Yeah, well, what really can we extrapolate from all this with a variety of data from different time periods that don't necessarily perfectly line up at this point, but if we, kind of sandwich it all together, are we seeing a strong sign, at least that things are remaining somewhat steady?
Right. Yeah. I mean, if we take the three pieces of data together, what it tells us is we went through kind of a tiny little bit of a rough patch in the summer. Things seem to be getting better as we're going into the fall. And the expectation is that the labor market will continue to improve into the winter, right? I mean, that's basically we're seeing, and all within a context of a little dip, but it never really got bad. And it's not necessarily the growth rate is not necessarily just taking off, full speed ahead, right? But just kind of a moderate level of strength in the job market and a moderate level of improvement is what we're seeing. So that's at least the conclusion I would draw looking at the data. And then where that probably has the biggest impact is with Federal Reserve policy,
Hmm.
right? The percentage probability that the Fed will lower interest rates in December has been bouncing around a lot. Started out very high. It was pretty much expected it was a foregone conclusion, and then it dropped down to about a 50-50 proposition, and now it's been kind of somewhere in between. And that kind of makes sense, in this this job market or jobs data. It does make their job a little bit more challenging. Their job is to maintain a strong labor market and keep inflation in line. And I think this report says that the labor market is still pretty strong. So, they're okay, check, mission accomplished. Then they have to keep inflation rate contained. And as we've talked about recently, inflation, the last report was 3%. Typically, a range between 2 and 3% is what's considered acceptable. So it's kind of right at the top end of that range. So maybe the Fed changes its focus from supporting the job market to more limiting inflation, which would mean they'd be less likely to lower interest rates or, even contemplate increasing rates, right? To keep inflation in check if they think the job market is strong enough. There's been a lot of talk. Different Fed governors have come out in support of different views. So I think it is pretty uncertain. Although, despite the stronger jobs market, it does seem like it's at least pointing to a higher probability of a rate cut in December than not. But if the trends in the job market continue, the trends in inflation continue, we could see the Fed go into 2026, much like it did coming into 2025, and pause the rate cuts to kind of take a wait and see approach going forward.
Yeah, yeah, and of course, as always, we'll keep an eye on it, and I'm sure we'll touch on it again here soon in the personal financial review. All right, let's dive into 2026 IRS Standard Deduction. The IRS Standard Deduction for 2026 will increase. What areas are we seeing the increases, and by what increments?
That's right. It's that time of year, right? All the IRS inflation adjustments, and we're making sure people know what those changes are and how it may interact with some other tax law changes, so they can start planning. So kind of the boring part, just the numbers. The IRS standard deduction for 2026 will increase by $700 for married couples, and by half that, 350 for single filers, and by $525 for head of household filers. So, see a small increase in the standard deduction, basically the deduction you can use to avoid taxes on that much more money. The goal being to keep up with inflation so that, as pricing goes up, people aren't seeing their taxes go up disproportionately. Now, so that's all a good thing and just kind of normal operation of the law. But, what's interesting is, the rule is you can either take the standard deduction, which is going up a little bit, or you can take the itemized deductions. We've also talked about the new senior deduction, right, for people over age 65, where they can add that to their standard deduction. So that needs to be taken into account. But the big change for 2025 and going forward for the next several years is the higher eligible deduction for the SALT deduction, the state and local tax. So that went from a $10,000 cap up to $40,000.
Oh, wow.
So, where that's interesting is a high income taxpayer, let's say it's paying a lot of state and let's say state taxes, income taxes, and real estate taxes. They can deduct up to $40,000. Well, the standard deduction for a married couple increased to $32,200.
Right.
So they could exceed that just on the higher SALT deductions, allowed for this year. Then you start throwing in other things like mortgage interest or charitable contributions, that type of thing. Now they may be back in a situation where they're itemizing their tax deductions again, rather than taking the standard deduction. So I think that's something we're going to have to pay special attention to this year, because really we've had this change in the standard deduction. We've had the change in terms of the senior deduction that'll affect some people, and in some cases it's blended. I've seen where one spouse is over 65, so they're getting it, but the other one's not quite there yet, right? So it's not the full 12,000. And then even with that, the higher SALT deduction, if they have charitable or some other deductions, we might be back to itemizing, and means we might have to gather all of that information to, find out what's the best option in terms of tax savings
Yeah.
when we're doing the filing.
Yeah, well, and I think the differentiation too between obviously the state and federal taxes as well, and how you might have to approach those a little bit different.
Exactly, exactly. Yeah, even those who may be claiming this, higher standard deduction, they may still be itemizing. It may still benefit them to itemize for their state return because a lot of states did not conform to the changes in the tax law that happened in 2017 and were extended more recently. So in a lot of cases, people that live in a state that has a state income tax, still need to gather those deductions.
Yeah. Anything else you want to add before we move to retirement plan contributions?
Well, just that in addition to the increase in the standard deduction, the breakpoints in the tax rates schedule will also increase at roughly 4%, 3.98%, which is pretty helpful. Actually, runs a bit above the inflation rate. So what that means is, in essence, you have to earn 4% more income to go into that next tax bracket, right? For each level. So it kind of pulls income back into a lower bracket to some degree. If your income stays the same, you'd actually see your tax rate, the tax that you owe come down. Your average tax rate would actually come down because the graduated brackets are actually increasing in terms of where you would enter and where you would leave a bracket. So that's another positive, very minor overall thing, but every little bit helps.
Yes, sir. Absolutely. All right. 2026 retirement plan contributions limits. The contribution limits for 401k plans increases as well. So let's dive on into 401k, also Roth and Roth IRA. So let's start with 401k. What are we seeing as far as increases there?
Yeah, some more inflation adjustments. So the way these work is, we get these limits, and then they apply the inflation rate, right? But they can only increase if they exceed a certain threshold.
Mm.
So, like with the 401k, inflation has to compound enough that it causes it to exceed $1,000, right? Then once it gets over that, okay, then the contribution limit goes up by $1,000 so that we keep nice round numbers. With IRAs, it's $500, right?
Mm.
So some years we get inflation adjustments because it, was large enough or it added up to enough to exceed that. And some years we don't because inflation was too small. It, only would have been a $200 increase, and that doesn't meet the $1,000 or $500 threshold, so we don't see the increase. So something we're always paying attention to, just because these are important numbers for those that really want to get the full benefit out of their tax deferred or tax favored savings. But so anyway, so going into 2026, 401k plans are going to be able to contribute $24,500 a year, which is a $1,000 increase from the prior year. And the age 50 catch up, so those that are over age 50 that can put an additional amount, that will increase by $500. So it'll increase up to 8,000. Um, so for those over age 50, basically a $1,500 increase in what they can contribute. Traditional IRAs and Roth IRAs, those contribution limits will increase by $500. And then, there'll be another $1,100 for the age 50 plus catch up. And then for small business owners, who are self-employed and able to do some of these plans like a solo 401k or SEP IRA where you can really contribute large amounts. That limit will actually go up to $72,000, which a lot of people that if it's a one person company, I've seen people get there. If they have employees, it becomes a little bit more expensive to get to that level. But yeah, quite a big chunk of money that you can get into a plan in 2026.
Yeah, no, well, and that's good to see for sure. But what about as far as income ranges for determining eligibility to make deductible contributions?
Yeah, those are still important, whether you could can make contributions to a traditional IRA if you're covered by a company plan, whether you can deduct or make contributions to a Roth IRA. Um, all of those things have increased slightly, but remain roughly the same, have the same phase outs. And so it's just really important that people understand broadly, what what their income's going to be, what their options are. Too often we're having to undo some of these contributions or make corrections, which can be a problem. It's also important people understand that the maximum 401k catch-up contribution for participants that are ages 60 to 63 during the calendar year remains the same, but it's bumping up based on this sliding scale that's being implemented. Kind of as we talked about with the Secure Act 2.0, they put in a bunch of just kind of weird provisions. And so going forward, this we believe will be the year that it will be implemented. There's still some discussion that it might get suspended because there's just been so much confusion. But those who are age 60 to 63 and making catch-up contributions probably want to talk with their payroll department or their 401k department at their employer to say, okay, what exactly is going to change here? How is this going to be implemented?
Yes. All right. Anything else you want to add before we jump to the bulletin board?
I just, like I said, with a lot of these contributions or making contributions to a Roth or something like that, I think it's really important to talk to a financial planner, talk to your tax preparer, make sure you run the numbers. It's very easy for people to fall afoul of, one of the limitations or one of the rules limiting what they're eligible to contribute. Like I said, then if you have to undo it, there's some aspects there that can be fairly costly.
Yes, sir. All right, let's jump on over to the bulletin board. We got two items pinned up on there, both awesome news. So let's start with the first one there.
Yeah, one of them. I think it's a good one of those good holiday stories, right? Warm your heart. But we had a client. He recently used our Plan Solutions Kings tickets to take his young son to a Kings game, and his son, he told his son was very excited to see one of his favorite players, Domantas Sabonis, right? The Kings center, probably, right now the most dynamic player we have, and he was really excited to see him play live. Well, where one of the ways that you can come in is down through the tunnel that goes right by the home team, the Kings locker room. And occasionally, I've been down there and I've been stopped as players were going by to and from the court doing warm-ups. And so they got there early and they happened to get lucky enough to catch Sabonis coming out of the tunnel. So they sent us this great picture, which obviously we can't convey on a podcast, but if you want to see it, it's on the newsletter that went out and told us, yeah, go ahead and share that. But it's a nice picture of our client's son, Domantas Sabonis, signed his hat, took a picture with him. So it was a nice, heartwarming moment, in a year where the Kings only have 5 wins, and it's been kind of a heartbreaker. I mean, we had low expectations going into this season, but it's been pretty bad. But it reminds you the cool things that sports can do, even when your team's not winning.
Yes, sir. Yes, sir. We've got some great news around Carter and Matt. What's going on with those two young gentlemen?
Yeah, this was big. So recently they both sat for the Certified Financial Planner exam. And they've spent years of studying, including, their college classes and things to prepare them for this. They spent hours doing exam prep, and were really, really grinding. And so, I think they were relieved. I think we were all relieved for them when they both passed. Both did really well. So that's a big hurdle. One kind of big hurdle that you have to jump behind them. And now they've met the educational requirement, they've met the exam requirement, so they just need to complete the required number of hours working in the financial planning field. Then they'll fulfill the requirements to be able to hold the certified financial planner designation. So they did a great job, and it's great to see them continuing to progress.
Yes, absolutely. Two awesome young gentlemen. Had the pleasure of meeting them at the golf tournament. Congratulations, Carter and Matt. Well done. All right, Mr. Armour, anything else you want to add while we wrap up this edition of the Plan Solutions Incorporated podcast?
Well, when this comes out, I can start saying happy holidays and things since Thanksgiving will be over. But yeah, just hope everyone has a happy, safe holidays.
Yes, sir. Absolutely. Well, thank you for listening to the podcast. If it's your first time, hit that follow button on whatever platform you're on. And don't forget, you can also go to our YouTube channel, youtube.com/@plansolutions. And you can follow along to a video form of the podcast, in which you'll see the personal financial review on screen, the written content that we discuss here. And it's a great way to get all this information as well. And if you have yet to subscribe to the Personal Financial Review, send Katie an email, katie@plansolutions.com, and get subscribed today.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.